LVMH's Luxury Challenge: Navigating Hurdles in 2024. The luxury world is in turmoil, and LVMH, the undisputed king of high-end brands, is feeling the heat. But is this a temporary stumble, or a sign of deeper cracks in the empire? Let's delve into the challenges and opportunities facing this iconic conglomerate in 2024 and beyond. A titan in turbulent times. LVMH Mode Hennessy Louis Vuitton SE, the Paris-based luxury behemoth, reigns supreme with over 70 prestigious brands under its umbrella. From the iconic Louis Vuitton and Christian Dior to the sparkling Dom Perignon and Tiffany & Company, LVMH dominates 5 key luxury sectors: fashion, wines and spirits, perfumes and cosmetics, watches and jewelry, and selective retailing. In 2024, their revenue soared to a staggering €84.7 billion, with fashion and leather goods leading the charge at €41.1 billion. But here's where it gets controversial. Despite its dominance, LVMH stock has taken a beating, plummeting 27.11% in the past year while the S&P 500 climbed 13.63%. This stark contrast highlights a global luxury slowdown, fueled by waning Chinese demand and market volatility sparked by looming U.S. tariffs. A closer look: strengths and vulnerabilities. LVMH's success hinges on its premium pricing strategy and the unwavering brand loyalty it inspires. Their global reach is impressive, with Asia, excluding Japan, contributing 27.5% of sales, followed by the US, 25.4%, and Europe, 17.2%. However, this very reliance on China, a market experiencing a slowdown, exposes a vulnerability. And this is the part most people miss. While LVMH boasts impressive margins, 67.03% gross margin, 23.12% operating margin, and strong cash flow, €14.7 billion, its valuation trades at a premium compared to its peers. This leaves little room for error if sales or margins falter, especially with potential tariff impacts and geopolitical tensions looming. The battle for supremacy. LVMH faces fierce competition from Kering, Richemont, and the rising star Hermès, each vying for a piece of the ultra-luxury pie. The recent dip in LVMH stock price, coupled with a sales miss in Q1 2025, briefly dethroned them as the most valuable luxury brand, highlighting the intensity of this battle. To invest or not to invest? The bull case for LVMH rests on its unparalleled brand portfolio, geographic diversification, and robust cash generation. The Tiffany acquisition strengthens their jewelry presence, while Sephora's online expansion fuels growth in beauty retail. The recent stock price drop presents a potential entry point for long-term investors. However, the bear case highlights the risks: a prolonged Chinese slowdown, the impact of tariffs, margin pressure from rising costs, and the complexities of managing such a vast portfolio. The premium valuation leaves little room for disappointment. The future unfolds. Key events to watch include LVMH's Q2 2025 earnings report, the implementation of U.S. tariffs on EU goods, and the unveiling of new collections at Paris Fashion Week. Sephora's loyalty program revamp could also significantly impact their retail segment. The verdict: LVMH's brand power and financial strength make it a compelling long-term investment. However, near-term headwinds warrant caution. Investors should consider a gradual approach, waiting for signs of margin recovery before fully committing. What do you think? Is LVMH's dip a buying opportunity or a sign of deeper troubles? Share your thoughts in the comments below. ****. Louis Vuitton's luxury struggles. What's going wrong? This week, decoding Louis Vuitton's struggles. What's unfolding? The luxury sector is facing a significant downturn, with industry giant LVMH anticipated to reveal a substantial double-digit drop in its fashion and leather goods division when it releases its quarterly sales and first-half profit figures on July 24. Size still a strength? Historically, during economic slowdowns like the 2008 financial crisis or the COVID-19 pandemic, LVMH's massive scale and diverse portfolio across various categories have provided it with a robust buffer, allowing it to recover faster than its competitors. However, this time around, companies like jeweler-centric Richemont, the independent powerhouse Hermès, and smaller entities such as Prada, Moncler, Zegna, and Brunello Cucinelli have demonstrated greater resilience, while LVMH's troubles have intensified. A significant factor contributing to this downturn is the perceived excessive price increases, often termed greedflation, in LVMH's core handbag segment. Additionally, the company is grappling with a generational shift in its leadership. Despite LVMH's unparalleled marketing budgets and influence with landlords, the rapidly evolving luxury market seems to favor more focused firms that excel in agile decision-making and execution. The upcoming quarters will be crucial in determining whether LVMH's current downturn is merely a temporary setback or a fundamental shift in the industry dynamics. Louis Vuitton under scrutiny. LVMH is confronting challenges across its key divisions, from layoffs at Moët Hennessy to declining sales at Dior, and a lackluster performance at duty-free retailer DFS. However, with a designer transition in progress at Dior and new management at Moët, these issues are increasingly viewed by investors as past concerns. Reigniting growth at Louis Vuitton, the group's flagship and most profitable brand, has become the primary focus. The world's largest luxury brand, contributing over half of the group's EBIT, appears to be at a critical juncture, noted HSBC analyst Erwin Ramberg in a recent client report. The brand's aspirational appeal is currently counterproductive. The conflicting pull between low-end products, like chocolate and beauty items, and high-end offerings, exclusive leather ranges, along with a mix of fashion content, Murakami, and subtle travel-related luxury items, raises pivotal questions. What does LV truly represent? Who is its target audience? What is its unique selling proposition? The establishment of a new deputy CEO role, with the appointment of former Loro Piana chief Damien Bertrand in March to support CEO Pietro Beccari, was seen by Ramberg as a red flag, indicating underlying issues at the brand. Balancing diverse messages, from hypervisibility to sophistication, premium and aspirational pricing, and core products to brand extensions, has always been integral to the megabrand's strategy. But if another quarter passes with Louis Vuitton losing market share to competitors like Hermès and Prada, as analysts currently predict, investors will inevitably ask, what's the strategic roadmap ahead? The week ahead is eager to hear your thoughts. Share your tips, suggestions, complaints, and compliments with us at brian.baskin@businessofashion.com. Disclosure: LVMH is part of a consortium of investors that collectively holds a minority stake in the business of fashion. All investors have signed shareholder agreements ensuring BOF's complete editorial independence. LVMH stock plummets. Will spin-offs or IPOs save the luxury giant? The glittering empire of luxury is facing its toughest challenge yet. Can LVMH survive its own sprawling success? Bernard Arnault built a titan by acquiring brands at a breathtaking pace, but that very strategy might now be strangling the golden goose. With stock prices plunging, management strain showing, and rivals outpacing them, the luxury conglomerate stands at a critical crossroads. But here's where it gets controversial. Could dismantling parts of this empire actually save it? Imagine steering a supertanker through a narrow canal. That's LVMH's dilemma with its 75 brands. While competitors like Hermès and Richemont demonstrate resilience, LVMH struggles with agility. The stock has nosedived 25% since January and halved from its April 2023 peak, wiping out €221 billion in market value. Astonishingly, Hermès, which Arnault once tried to acquire, now holds the title of France's most valuable company. Arnault's personal wealth has mirrored this freefall, dropping from $231 billion to around $150 billion. But don't mistake this for bankruptcy. The paradox? LVMH's financials remain robust. Debt ratios improved from 20% to 13% since 2021. Operating cash flows surged over 25% to €10.5 billion in 2024, and the Arnault family has been aggressively buying shares during the slump. The real crisis stems from operational bloat. This wolf in cashmere has too many prey. Rumors swirl about underperformance at Dior, Moët Hennessy, and even flagship Louis Vuitton. More fundamentally, managing 75 distinct brands creates logistical nightmares, while the absence of a clear succession plan for 76-year-old Arnault keeps investors awake. Here's the explosive solution analysts propose: radical simplification through spin-offs or IPOs. Top candidate? The Wines and Spirits division. Moët Hennessy has transformed from a €1 billion cash generator in 2019 to burning €1.5 billion in 2024. Analyst Luca Salca argues it's become marginal compared to fashion/leather goods, with incompatible wholesale distribution models and stifled innovation. Controversially, alcohol also repels ESG-conscious investors. Two paths emerge: a spin-off preserving French ownership, like Richemont's tobacco move, or selling majority control to Diageo, which owns 34% already. But here's the twist: Diageo faces its own leadership crisis after CEO Deborah Cruz's disastrous tenure saw shares plummet 43%. Other candidates include smaller fashion houses like Off-White and Stella McCartney, already sold, or even cosmetics giant Sephora. Analysts clash fiercely here. HSBC's Erwin Ramberg sees Sephora's retail model as non-essential long-term, while Salca argues for keeping its synergies with perfumes and cosmetics. And this is the part most people miss: LVMH's legal landmines. Subsidiary Loro Piana faces criminal oversight in Italy for alleged migrant worker exploitation, with prosecutors claiming workers slept on factory floors while paid below minimum wage. Dior faced similar scandals last year. Both incidents revealed the dark side of luxury's supply chain. Looming over everything? The succession question. Arnault secured CEO age limit extension to 85 and installed Deputy Stefan Bianchi, but with his children still developing, the elephant in the room remains unsettled. As the luxury sector's €364 billion tide retreats, LVMH must decide: can it thrive by becoming smaller? Or is fragmentation a fatal mistake? We're facing the most fascinating corporate drama in luxury history. What's your take? Should LVMH dismantle its empire to survive? Drop your boldest opinions below.